Hi, this is Ansar Hadi. Now I am discussing about the life insurance basics. Many financial experts consider life insurance to be the cornerstone of sound financial planning. It can be an important tool in the following situations: replace income for dependents. If people depend on an individual's income, life insurance can replace that income if the person dies. The most common example of this is parents with young children. Insurance to replace income can be easily, especially useful if the government or employers sponsored benefit of the surviving spouse or domestic partner will be reduced after he or she dies. Pay final expenses. Life insurance can pay funerals and burial costs, probate and other estate admin, administration costs, debates and medical expenses not covered by health insurance. Create an inheritance for heirs. Even those who with no other asset to pass on can create an inheritance by buying a life insurance policy and managing their heirs as beneficiary. Pay federal death taxes and state death taxes. Life insurance benefit can pay for estate taxes so that heirs will not have to liquidate other assets or take a similar inheritance. Change in the federal death tax rules through January 1st and 2011 will likely lessen the impact of this tax on some people, but some states are offsetting those federal decrees with increases in their state level as state taxes make significant charitable contributions. By making a charity the beneficiary of their life insurance policies, individuals can make a much larger contribution than if they donate the cash equivalent of the policy's premium. Create a source of savings. Some type of life insurance create a cash value that if not paid out as a death benefit can be borrowed or withdrawn on the owner's request. Since most people make paying their life insurance policy premiums as high priority, buying a cash value type policy can create a kind of forced saving plan. Furthermore, one interest credit is tax deferred, a tax exempt if the money is paid as a death claim. Type of insurance. There are two major types of life insurance terms in whole life. Term life. Term insurance is the simplest form of life insurance. If pay only if death occurs during the term of policy, which is usually from 1 to 30 years. Most term policies have no other benefit provisions. There are two basic types of term life insurance policies: level term and decreased term. Level terms means that the death benefits stay the same throughout the duration of life of policies. Decreasing term means that the death benefit drops, usually 1 year increment over the course of policy's term. Whole life or permanent life. Whole life or permanent insurance pays a death benefit whereas the policy holder dies. There are three major types of whole life or permanent life insurance: traditional whole life, universal life, and variable universal life, and there are variations within each type. In the case of traditional whole life, both the death benefit and the premium are designed to stay the same level throughout the life of policies. The cost per $1 of benefit increase as the insured person ages, and it obviously gets very high when the insurance life to 80 and beyond. The insurance company keeps the premium level by charging a premium that in the early year it higher than the it is needed to pay claims, investing that money and then using it to supplement the level premium to help pay the cost of life insurance for older peoples. By law, when these overpayments reach a certain amount, they must be available to the policyholder as a cash value if he or she decides not to continue with the original plan. The cash value is an alternative, not a traditional benefit under the policy. In the 1970s and 1980s, life insurance companies introduced two variations on the traditional whole life products: universal life insurance and variable universal life insurance. Some varieties of whole life payment life insurance are discussed below. Universal life. Universal life, like also known as adjustable life, allow more flexibility than traditional whole life policies. The saving vehicles, called as cash value account, generally earns a money market rate of interest after money has accumulated in the account. The policyholder will also have the option of altering premium payments providing there is enough money in the account to cover the cost. Variable life. Variable life policies combine death protection with the saving account that can be invested in stocks, bonds and money market mutual funds. The value of the policy may grow more quickly but involves more risks. Its investment do not perform well, the cash value and death benefit may decrease. Some policies Some policies, however, guarantee that the death benefit will not fall below a minimum value level. Variable universal life. This type of policy combines the features of variable and universal life policies, including the investment risk and rewards characteristic of value life insurance and the ability of the adjust premiums and the death benefit that is characteristics of universal life insurance. Annuities bases. Annuities are beneficial products intended to enhance the retirement security, and annuity is a agreement for one person or organization to pay other a series of payments. Usually, a term annuity relates to a contract between an individual and a life insurance company. There are many categories of annuities that can be classified by nature of underlying investment, fixed or variable premium purpose. accumulation or payout deferred or immediate, tax rate qualified or non-qualified, premium payment management agreement, single premium or flexible premium. An annuity can be classified in several of these categories at once. For example, and individuals might buy a non-qualified single premium deferred variable annuity. No, next we discuss in next lecture. Okay, thank you.